So in 7 years, you guys have done 2 billion in transactions. So I'm still trying to figure out how you did that. So in such a short period of time.
Everybody teaches about like how to underwrite these deals, what to do in the beginning, do due diligence. Nobody ever freaking talks about like operation.
There's the jockey and the horse, right? The jockey is the operator, and that is as important, if not, I think more important than the horse, which is the vehicle, the asset class, the business strategy, the model. A lot of people bet on the horse and not the jockey, and then they lose all their money.
At least what I've learned is, we can't just be a one-trick pony anymore, right? The light value add, lipstick on a pig, renovate flooring, appliances, new paint job, new playground equipment. I mean, that works in certain markets, and I think it's a great business plan, but it just doesn't work.
So, like, who are you partnered with? What's your structure? How are you raising capital? Today we are joined by Lane Kawaoka from Oahu, Hawaii, and I'm so excited for this conversation. You have just, accomplished things that many people just don't even dare to dream of. So first off, congratulations on all your success. And I know you recently launched a book called The Journey to Simple Passive Cash Flow. So excited to dive into that. And you have raised hundreds of millions of dollars. You were an engineer for many years, which I was an engineer too in my past life. And then you decided at some point to quit and go full time into syndications and then raising money for your fund. And you now control over 10,000 units and have $2.1 billion of assets under management. So excited to dive into it, and thank you for coming on the show.
Yeah, thanks for having me. Aloha, everybody.
Aloha. So what was that journey look like from you? I know I was reading your bio and getting to know you a little bit, and you mentioned this story of leaving the dark days in Seattle from your engineering job and then deciding to quit and go into real estate full time. So, like, what are some of the mental and emotional things that were going through your head that made you move back to Hawaii, quit your job, and go a completely different direction?
Yeah, I mean, it was a long time coming. I mean, started investing in 2009, and I didn't really hit that tipping point till 2018. I think up to that point, I think maybe we started to get traction on the real estate operation side, the syndication side, but all the way up from 2009 to 2015, 16, I was just a passive investor, working his engineering job, trying to live two lives, right? And I think, to kind of talk more about the mindset, you got to kind of put your head down and not really talk too much about what you do, because not everybody thinks that you're not super dedicated to your engineering job or your W-2 job. But, for, a lot of you're going to school, right? A lot of college, like kind of preparing you to get a degree that you're supposed to stay in it for decades. And that's kind of leaving that life behind.
And you, similar to me, you started investing in real estate while you were an engineer. And what gave you the bug? Like, how did you even learn about real estate?
I bought a house to live in because that's what we're all taught to do, right? We kind of follow the dogma like little lemmings, and I bought a house to live in a couple years out of graduating college. Back then I was saving maybe 30, 40 grand per year. So saved up pretty quickly, and then I was home all by myself because I traveled for work. I was a construction supervisor back then. So I was 100% travel. So I was only home on Saturday. I was like sitting there in this big house to myself in my early 20s. And I'm like, this is a little like, doesn't seem like we're getting the most use of this asset, right? Other than holding my stuff through my week while I'm working. And that was kind of where, just on a whim, I just started to rent it out. But that was kind of where I got that taste of cash flow, right? In the beginning, it was just a lot of beer money. And, I guess that was cash flow, right? But then I started to realize, like, wait a minute, if I just rinse, wash, repeat, did this a few more times, I'd be able to turn this into a thing and escape the rat race.
And so you ended up buying 11 rental properties in multiple different states while you were still working?
Yeah, so bought that first one was in Seattle. It was everything you're not supposed to buy in terms of a rental property. If it would have bought it a few years later, would have never cash flowed. Didn't know any better, but then I bought a duplex that was more of a B class renter type. But Seattle's a very expensive place, and it's a blue state too. So started to buy properties remotely, Birmingham, Atlanta, Indianapolis. Started to do that turnkey rental thing that I think a lot of investors get into. And from 2012 to 2015, started to buy a lot of these smaller turnkeys out of state. Um, but all during that time, I think what really put me on the map was there was a few 4 or 5 years there where I was pretty much had no rent or mortgage because I was living off the company dime and able to put away like 6 figures every year to down payments on these properties.
Awesome. And so what company were you working with? So for those of you who don't know, there are companies out there that do sell turnkey rentals where they'll renovate them, fill them with a tenant, and then they'll even manage them for you. So it's a great opportunity for people to be able to buy rentals, but not have to do the, toilets and drama and trauma, whatever that quote is in the rental space. So yeah, who did you work with and how did that work out for you?
Sure, I don't even think they're in business anymore. I mean, I don't think there's any margins in that world anymore because I think it used to be where you would have like a marketing company kind of playing the middleman to the house flipper, and they would be able to upcharge like you buy $120,000 property, but they sell it to you for 130 because you're just an unsophisticated turnkey investor. Um, and so I kind of caught onto that pretty early that these guys were just, increasing the price by 5 grand, 10 grand. And I just went straight to brokers. So I kind of gambled a little bit in the beginning there. But I definitely found like the brokers that also did property management because there's a big difference between people finding you retail houses versus those who, I think actually like in some of my markets, I actually got the broker to who was a property manager, right? I started with the property manager and I said, hey, help me. You have a like real estate license. Help me buy a property. We'll put it into your portfolio after.
Okay. And you were buying like $100,000 properties?
Pretty much. I mean, back then it was like I was able to buy them at like 80 grand a piece and you hit that 1% rent to value ratio. But, these days those same properties would probably be 140,000
Yeah.
buy-in.
How did you decide what states to invest in?
Red states, and yeah, just listening to all like the marketing out there and podcasts, right? They all said at the time they all said to go to Indianapolis, Memphis. I think some of the locations have changed because certain places, like Birmingham, used to be a great place, but it's just gotten too damn expensive to make the numbers work. I think nowadays, I think you see some turnkey providers out of Baltimore, which is like just not the best of areas, if you ask me. But
Yeah.
from a location standpoint, but hey, that's what they've had to do, right? With prices getting more and more and more, and it's just I think especially when you got past this side of 2015, 2016, you weren't able to buy properties at that basis, and you were no longer able to cash flow. So to me, like it was kind of like being in the pond and the water constantly getting higher and higher, and it kind of forced me into adding value, right? Where traditionally I was just a passive investor. I never did wholesaling or flips. I was lucky enough to have some money to get over that step, but to progress as an investor, I had to kind of put the operator hat. And partially, I think that was kind of why I quit the engineering job too.
Why?
Because you can't just, like, you can do essentially what I was doing initially was the buy, hope, and pray strategy,
Yeah.
right? So 20% down payment. I was lucky enough to be a good saver, save my money, put 20, 25 grand down, buy a property, rinse, wash, repeat. But at some point in that timeline, you weren't able to cash flow comfortably $200 per month. So what do I do other than just sitting on my butt and complaining to the world that everything is just getting more and more expensive? But now I got to take on more audacious business plans and renovate units. And that was kind of where, I started to interact with other accredited investors, and all of them kind of came from the same path where, yeah, we started out with single family homes, but they're just not scalable, right?
Hmm.
With 11 single family homes, I had maybe an eviction or two every year, some kind of big catastrophe every quarter, like a tree fall on the house or like a flood in the basement from a rainstorm, which was not a huge problem because I had property management on all these assets. How else would I work a full-time engineering job? But all that for what, a few $1,000s per month across 11 properties. It just, most of my clients today, need ten to $25,000 of cash flow per month. And therefore, you're going to have to increase the exception rate by 3 or 4 times. So now you're talking about an eviction every month,
Yeah.
like some kind of big issue every week, and that's just not scalable. And then when your net worth gets above $1 million, certainly now you're more of a target to get sued because you actually have something to lose. And that's kind of where the transition to going to more of the LP position, where you're not really on the chopping block as that in terms of liability, became more of a forefront. And then additionally, I don't know what the rules are today in terms of residential lending, but back then you got capped out in 10 Fannie Mae Freddie Mac loans in your name and your spouse's name. So
Yeah, it's still the same, I believe, today on the residential side. We do commercial lending, so I don't really touch any owner occupied stuff, but I believe it's the same.
yeah, I
Um,
think I think it is. Yeah,
yeah.
yeah,
So when did you sell those assets?
yeah. I quickly sold them. So what I did is I started to learn about, I mean, I was kind of like, well, single family works well. Let me do something like not super breathtaking, but let's go to multifamily, right? Like, go
Mhm.
figure. Just follow the breadcrumbs. So I started to learn more about that, started to learn how to underwrite those types of deals, which is more complicated, but if you have some experience running single families, you just divide it by the unit count, right? And you can kind of digest it in your head a little
Right.
bit better. And that was kind of where I started to learn more about that, get more involved as an LP side and the GP side on some of these deals. And, just like when I tested out a little single family home out of state when I lived in Seattle, it's the same process. Try it out and then swiftly sell off my assets and move them over the next couple of years. Luckily, I think I had maybe a couple $100,000 to kind of get me started before selling off all my eggs that I had previously purchased over the years, namely the 11 single families. But yeah, use the lazy 1031 exchange to just sell them off and quickly go into deals and capture those losses to offset it at that time.
Yeah, that's awesome. So you did you do a reverse 1031 exchange, or did you crunch the time and find a property and sell them all at once?
So I don't know if it's an official term, but some people call this the lazy 1031 exchange. You don't get a custodian or anything, but you just kind of do it all in the same year. Like, if you go into a deal, and that gives you, you're on the equity side that has passive losses, or especially doing bonus depreciation, do a cost seg. You typically get like this huge amount of passive activity losses, PALs for short, and it's way more than you would get with normal single family homes with 1/27 the depreciation over 27 long years. So like, I think I early on my first few years I must have deployed a quarter million, half a million, and I was kind of swimming in maybe half a million, or maybe a little bit less, like 300 $400,000 of passive losses. I can't remember exactly, but more than I would have needed. So
Hmm.
I used that to offset the gain. I think one year I had a capital gain from my selling my single family homes, and it was really big because I had previously 1031 exchanged it,
Mm,
right? So it had been building up.
yeah.
But because I had several $100,000 of suspended passive losses built up, I was able to tap that and offset that capital gain in that year. So that's what people call the lazy 1031.
And were you, because I'm trying to remember, when did cost segregation come into play? That was in around 2016, I think,
Yeah,
right?
so when Trump got in there the first time, he kind of put it in place. I think when he got in, he put it in place about a year later, but he made it retroactive to when he came in. So that was actually a good timing, but in reality, the 100% bonus depreciation is not a huge deal, right? If you do a cost segregation with or without 100% bonus depreciation put in place, you should be able to extract a lot more losses that first year than you would have, like I said, with or without bonus depreciation.
Yeah.
And that's kind of the beauty of when you do a cost seg on a bigger asset. But usually cost segregations cost maybe 5-8 grand, which if you're doing it on a single family home property, probably doesn't make sense, right? As we say in Hawaii, ho ho, right? It's like lose money doing that. It's the waste. But on a bigger commercial asset, 5-8 grand to do a cost seg to extract those losses earlier than later is definitely more cost effective.
Yeah, it's a game changer for sure. And different asset classes have different levels, different amounts that they could be cost segregated. So you're in asset classes like multifamily. You're also in storage and mobile home parks, or mobile home parks and RV parks.
I've done a little bit of that as an LP, right? Like
Okay.
I mean, in the beginning, I really went all over the place, but then I, I'm an operator, right? So I kind of want to stick to my own home cooking, things I do myself, but also things like I know, right, where I can underwrite and like we look at a deal and we for example we know the property management firm, right, or we have comparables, we can baseline even our own units on what that operator is using in terms of their comparables, like that sort of insider knowledge. So I tell people, like, yeah, don't listen to what I do, right? Like I'm a little bit less diversified, or actually a lot less diversified than your average passive investor out there.
So are you're managing your own fund though now and raising capital, correct?
Yeah, so I mean the what we've done has kind of changed and pivoted over the years, right? Like
Okay.
when we first started to do this pre 2020, interest rates were all-time lows, right? Everybody was kind of just feeding at the trough of free money, and there was a lot of cash flow in a lot of these deals. In 2022, like we kind of, that was kind of an error. I do believe. I don't think interest rates, the Fed rate's going to come under 3% in
I
maybe
don't
in the
think
next
so.
decade. I mean, at least that's what the Chatham Financial Curve is saying.
Yeah.
But that's where for a while there, we didn't acquire anything. I mean, that's why the market went down so much, 20, 30% off the peaks, because even us as buyers, we stopped buying. And when
Hmm.
it's pure economics, buyers and sellers, when there's less buyers, prices go down. So I think that's kind of where, like, we've kind of pivoted a little bit. We're looking more to private equity, to getting things outside of real estate, because right now it's hard to make buy and hold multifamily, that typical model where you're doing light renovations, 5, 10 grand per unit, bumping the rents up $100, $200 per unit. It's hard to make those deals work these days because taxes, insurance went up, and then inflation. There was a property that I bought in 2020. It was a 300 unit. Initially, when we purchased it, the tax was like 150,000 for the property a year, and then I think now it's like in the 400s. It's just phenomenal.
Yeah, the insurance and the taxes has gotten so astronomical. It's insane. And the price, it's still so hard to make deals pencil. I mean, now we're starting to see it be a little bit easier to make deals pencil because now there's more distressed debt. We have $1 trillion of commercial debt coming due this year, which has already started. A lot of that's come due. So we've already seen a lot of things start to trade at a much better basis than the past couple of years. I think the past couple of years, it was very much like a stagnant, stalemate type market. And there just wasn't a lot going on because prices were high. Inventory was still low, but buyer demand was low, but it was just a pretty wonky time. So it's nice to see things are starting to trade again and deals are starting to make sense again. And although it's still hard, but I think it'll continue to improve. And, now that we have the 100% bonus depreciation is back, and I think it's going to be a little bit easier to start raising capital again, and then good sponsors will have the ability to scoop up some of these distressed assets at much lower prices. I have one closing today that's selling for half of its loan balance. So those are some pretty good deals.
Yeah, yeah. I mean, at least what I've learned is, we can't just be a one-trick pony anymore, right? The light value add, lipstick on a pig, renovate flooring, appliances, new paint job, new playground equipment. I mean, that works in certain markets, and then I think it's a great business plan, but in certain markets, or microeconomic climates, it just doesn't work. So in 2020, we started to do a little bit of development too. Um, I think even that is very dependent on interest rates too, right? But the nice thing about that is you create so much tremendous value, where in light value add, all you're really trying to do is bump the NOI by 10 to 20%. Now, if you're fully leveraged, that'd be more than enough to double your capital, your equity, right? But in developments, I mean, you're talking almost infinite in terms of NOI bump. I mean, you're going from zero NOI to what it is. And so it's a much big jump up. Obviously, more risk, right? And I think that's the general trend. And investors may not want to hear that, but you have to go to essentially more audacious, riskier business plans to chase alpha. Yeah, it's not, but this has been happening since the beginning of time. It's not getting any easier for anybody.
Yeah, and I always say I actually get excited when there's a higher barrier to entry because it's less competition. More people. The word development sounds a lot scarier than let me do a light rehab, a light value add, and it's just a higher barrier to entry. And so that's why people that are really good at it, they dominate, they crush. And I talk to tons of developers all the time because that's our client base for HB Capital, and some people have absolutely killed it even through all these storms like the past few years with interest rates and everything. They lost some profits, as far as not as big of a slam dunk but still a pretty big slam dunk, and they've just really mastered their craft.
Yeah, and I think to highlight what you said there, like when you get into something, you want to find something with a little bit of barrier to entry. I wasn't super keen to this in my early days because, I mean, what's easier than buying a little single family home rental property or getting real estate's the easiest type of investment class to get into. Obviously, there's some downsides too, right? There's not too much you can do it when rents start dropping at the same time too. There's not
Right.
too many levers to pull, but like that was why we kind of moved a little bit to the development side too, because just from like a lending standpoint, with large multifamily deals, 100 unit, 200 unit apartments, as long as you have somebody on your team who has the Fannie Mae, Freddie Mac card, you know, you can get a loan. Um, Very different story in the development world, right? You have to really show true experience, operational experience to kind of get in the door that way. And that was kind of where I think, pre 2018, 2020, it's very competitive because the barrier to entry to buying large apartments is rather low. So we're trying to search for these opportunities where, just I mean that particular instance, it's like the qualifications for lending, right, is a little bit higher for development. And now today, buying particular businesses, you need the expertise of a particular owner, right? Not everybody can run a termite business, right? Not any banker from New York can't do that. That's for sure.
Yeah. Yeah, you need the experience. And just like you said, that's what makes the barrier to entry high. You can't just go get a development, construction loan. They want to know who's guaranteeing this loan, what's your net worth, what's your experience, how many projects have you completed in the past 36 months, and make sure that you're actually a secure borrower. And then it can be hard if you're brand new. How do you identify that credit partner who can show the financials and can show the experience, and then like really what is your value, right? And so there's just that balance of breaking in. So that's why it's easier to start with value add stuff, show that experience under your belt, do some heavier and heavier rehabs, and then you have some real value, real experience, something to really bring to the table, and then the ability to find a partner to go into these deals on. Like I was just talking to a client of ours. We're going to be financing their 4 towers that they're building. And he came from the residential place. So he was doing fix and flips, single family fix and flips. Then he got into single family development, and then he moved his way into commercial development. Now they're doing large, mixed use towers and stuff. So it's pretty cool to kind of see that transition. But how did you guys transition into development? Like who's involved in your company, and how did you guys make that transition, and what barriers did you face or challenges did you face as you started to make that transition, especially in a challenging market?
Yeah, I mean that transition was relatively easy because we just brought on an experienced development partner who had the construction background and was a fellow engineer to myself. Um, but like you said, it was like, I mean, you kind of just quickly went over it, but it's easier said than done, right? Like when it's a chicken and egg thing. When you're getting started, it's really, really hard to kind of get that Fannie Mae Freddie card or that experience card or whatever you're looking for to get qualified for these larger loans. Initially, what I did is, this is like 2016, I just started to network and kind of got on like, the kind of the grunt work level involved in some of these deals. And I think this is kind of where I was able to kind of learn, or, people use the analogy for these syndication deals as like the airplane where in the cockpit you have the general partners, loan guarantors, and the LPs are the in the back seat in coach. But what they don't talk a lot about is that there's the jump seat in the airplane, right? To deadhead pilots back and forth. But in this analogy, I sat in on that jump seat a lot of times, and I could see how different people did different deals, could learn without playing around with the controls myself. So it was a great opportunity for me to get a look behind the scenes, and it's very different than what LPs see, that's for sure. And definitely helps me do underwriting on new deals today, and then gives me empathy on kind of what investors are looking for, because I'm kind of in between there too. But from a qualification standpoint, and I know you guys kind of help people navigate these worlds, and that's always a big help, having a broker to kind of help you do this. But um, yeah, I would say, like, yeah, try and get on the jump seat on one of these deals, and then use that to build your resume, and then have somebody like you guys kind of massage the resumes, and yeah, kind of just, at least you're working towards something.
Yeah. How did you find that opportunity to, like, what did that structure look like where you could
Yeah,
learn
I
and bring
mean,
value?
back then there were a lot of these like investor groups out there. A lot of them are like pay to play though, which I think is helpful. It I don't know if these groups are entirely useful, um, if not for like motivation and finding these groups, like these people, right? Potential partners to go in. Especially when you're in the infancy stage, right? Trying to get your Fanny card, or being a key principal loan grantor on one of these properties, or just like how I did, just sit on the jump seat and just learn without being the guy. Um, but yeah, like that's there. I would say that after the mass exodus in 2022, 2023, I don't know if a lot of these kinds of groups still get together, but I do think that they're still out there for sure. But that's, like anything, you got to find the ecosystem, the incubators.
Yeah. What is that group gone? That one in particular?
I don't know. I don't know.
Okay.
Yeah.
And you weren't investing in the deal. You were just kind of learning from, they were reviewing a deal, or how did you get involved?
Yeah, I mean, I would actually be on like the management team, and then also investing as a passive too. So
Okay.
and in those instances, I guess I found this out later, right? Like I was investing with a lot of unproven operators, or what they call emerging operators, people what I call under $1 billion of assets. Um, Maybe not the best place for my money back then, but hey, I got through it, right? Like, knock on wood today.
Did
Um,
you have any LP investments go bad?
Oh yeah, for sure. That's what's going to happen when you're working with operators under $1 billion of acquisitions. Today we've got over $2 billion of acquisitions. In 2020 went over 1 billion, but before then, you're learning on the job.
Yeah.
Everybody teaches about like how to underwrite these deals, and what to do in the beginning, do due diligence. Nobody ever freaking talks about like operation, and nor like, I don't know if you could put it in a textbook or a curriculum, because it's just pure entrepreneurship, and it's not doesn't take a genius to run an apartment, for example, right? Like I said, real estate is one of the easiest asset classes. Not to poo-poo it, right? But it is one of the easier asset classes out there. So, from an investment standpoint, one could just review the numbers and make a good educated decision whether to invest. Um, Especially like when you compare with private equity. In private equity, it's the opposite. The operator is so much more important than the idea or the asset.
Yeah, I just came from a podcast with Andrew Abernathy. He does storage, class A storage developments, and we were talking about that too. Is like there's the jockey and the horse, right? The jockey is the operator, and that is as important, if not, I think more important than the horse, which is the vehicle, which is the asset class, the business strategy, the model, things like that. So it's so important. And I think a lot of people bet on the horse and not the jockey, and then they lose all their money because sure, it might be a good deal and a good opportunity, but if you don't have the right person riding the horse, they're not going to win. They're not going to win the
Yeah.
race.
Can I add a few more parts of that analogy? Because I love that analogy. Um, you got the racetrack. The racetrack is kind of like the market, the macroeconomic climate. You can have the best jockey and you can have the horse on steroids. But if you're in a market that, like we've seen in 2022, where interest rates skyrocket and you're just in the wrong loan package, it's all
Right.
gonna hurt, right? And that's why you try and diversify into many deals, and especially a lot across 4 to 7 year time horizon, right? I think that was kind of where we came out ahead. I mean, we've had our lumps for sure, but we've been active prior to 2020, and have some of those properties still owned today, to be able to ride the waves out. And then another part of that analogy is the stable hands. The people, kind of the pit crew, right?
Yep.
If you use the race car analogy, those are your LPs, right? Some LP groups, these days we like to invest alongside more family offices or more institutional investors, because when problems do come up, issues do happen, they can put up the money, right? Whereas sometimes when you're working with retail investors, your doctors, your engineers, it's really hard for them to write a $25,000 check, right? That's what is needed to get out of the pit stop and moving. But yeah, that's the nature of investing in ventures, right? There will be problems that do come up. Hopefully not. Hopefully it's smooth sailing. But yeah, that's you got the horse and the jockey are probably the big ones. And I think too often people say, well, just bet on the good operator, right? The jockey. Um, I think they say that because they might be talking to more of an unsophisticated investor base that has no bearing in, they don't, that's the problem with LPs is, or LP's problem is they don't get access to raw financials, P&Ls, rent rolls. So I'm like, well, what due diligence are they doing, right? Like, how do you know the rent comps are totally out of whack, or they're assuming the rents are going to go up 4 or 5% every single year on top of the 200%, the $200 rent increase. That's a little bit way out there too. Um, and that's just how it is, right? In the retail investment world. Now, when you get to
Yeah.
more family office, more institutional level, there are no pitch decks really. There's just give me the P&Ls and rent rolls. I mean, that's what we say, right? Give me the P&Ls and rent rolls. I don't want to hear your commentary about the project. I mean, just run the numbers, see what it's worth today, and run my own comps based on what I know about that market. Again, if I have properties in that area, I even have a better insight into it. But yeah, like it's all numbers, and this is how the big firms do it out of New York, right? I mean, it sounds it's at some point you put a boot on the ground, you kick the dirt, but a lot of this initially should be done just with raw financials.
Yeah. How did you go from, buying $100,000 houses to investing as an LP here and there to now having done $2.1 billion in acquisitions?
I think they always say the first one's the hardest one. Yeah, it was the first one was like a little 50 unit. Um, didn't have too many investors back then, so it was a struggle to get $1 million. Put a big chunk of my money in and just learn by doing, and then just rinse, wash, repeat, do it again.
So that was a syndication. That was your first one,
Yeah.
apartment. And so did you have any partner or were you the only GP or what was that structure like?
Yeah, there were a few of us. It wasn't a huge general partnership, but yeah, there's I mean, a lot of it is kind of natural if you're like into like project management and you can get things done. That's why I prefer to see, when I invest and evaluate a sponsor, an operator, I like to see, obviously you want to see a track record, right? But if they haven't done $1 billion of past deals, I at least want to see them working for a Fortune 500 company in a director level or above for at least 5, 10 years. Um, college education. I mean, I'm not huge on college education being that great, but it's good to see on somebody's resume. I mean, I might be wrong, and this might be totally like wrong, but hey, it's my money. I can be as
Right.
discriminatory as I'd like, is what I'd say.
Yeah. And so and then that property you sold it and then you 1031 into another one, a bigger one?
No, just I mean, since the beginning, I've just been doing the lazy 1031. Um, I mean, I've never really personally run dry on passive activity losses. Yeah,
Okay. So did you did you sell that asset or did you hold it?
we sold that. Yeah, I think we
Right.
we sold that. I think after 20, I don't know, I can't remember after 2020. I think we held it for like 3 or 4 years.
Okay. And then you just bought a bigger one and you raised more money.
Yeah, I mean, it all gets lost in the shuffle, right? Like, I mean, when at that point you stop drawing like the push pins and the strings, and it just kind of goes into your investment portfolio, right? And you're just constantly, turning these things over, and that's why I tell a lot of folks like a good framework is, you never want to invest more than 5% of your net worth into any one thing, right? That way you're kind of having some guidelines on diversification because you do want diversification. But if you also are able to save 50 grand per year or quarter, now that allows you to go into a deal once a year or ideally 4 times a year, right? So you're not super desperate to deploy capital. At the same time, you're able to build this pipeline. If you do this for 5 years, which is the normal timeline for most value add projects, some are quick flips. You can get it done in a year or two. Some are longer, right? But on average, theoretically, you go with a 5 year time horizon, and if you do one a quarter, that's 20 deals. 20 deals at $50,000 a pop. What is that? I think that's 7 figures, right? $1 million. I think that's a good theoretical, model to kind of start off with. Of course, things are going to change, right? As any deal you get into, projections change right off the bat, and just like building a alternate investment portfolio, right?
And have you so yeah, I know here it says that you started the family office Ohana, where you did a retreat in Hawaii for sophisticated and accredited investors, and then now uh, you run this mastermind or this group still today.
Yeah, I mean, that was kind of what I struggled with initially, right? Like, I didn't have any rich uncles. My parents
Yeah.
never owned rental properties. They always told me that don't own rental properties because your tenants will screw it up or you'll get sued.
Mm-hmm.
So I didn't know what a credit investor was, not too long ago. So it was really hard for me to kind of understand what wealthy people do. And that's why I wrote my book, The Wealth Elevator, which is the new one. You guys can pick that up on Amazon, but it kind of identifies different layers to the wealth building journey, right? Like everybody writes these books on how to get out of debt, the Susie Orman, Dave Ramsey. This is not the book on that. This is, there's phases to this. The first floor is where I was non-accredited investor buying little single family home rentals. And then when my net worth got over 1 million, I was on that second floor, getting more involved in these alternative investments, syndications, etc. And then, getting to the next peak over, right? And the next peak over is kind of when you get around $4 to $5 million net worth for most people, right? You have enough. You're supposedly financially independent. You could take all your money and take it out of equity deals and stocks and put it into T-bills and chill, or life insurance at 5%, right? But people have a choice whether they want to try in the next generation. And this is why it becomes like a family thing, right? We tell people to bring their families to this. They're likely not going to get to 20 million, $100 million in their generation, but they can put their family on a path to getting there. But to ascend to our goal, and at least in our members' lifetime, is to get them past that was an 8 figure mark. And that's what this group is, right? Like it's a cohort of investors who apply the framework of alternative investments, whether that's self-storage, multifamily, whatever, or things outside of real estate, privately sourced deals, institutional quality deals that are off the beaten retail market, right? Um, all these alternative investment tax strategies and a little bit in infinite banking, and that's kind of the formula that we follow.
And how did you, when you were launching that group, how did you market for it? Like, how did you get your batch of people to come to a retreat? And what does your kind of structure look like? And yeah, how did you grow it and how many people are in it?
Yeah, I think the first year we did it was for that 2000. No, I mean we've always done little events from like 2017, 18. Initially, like I would just, when I was in Seattle, we take people on like a wine bar crawl, right? Um, or if I go to LA, like we do a little kind of more meetup kind of vibe. In 2019, right before the pandemic, we kind of made a more of an attempt to do more of a formalized event in Honolulu, Hawaii, but completely opposite of your conference, right? Which is mostly paid speakers and the attention is on the stage as opposed to with the individual people. So when we do events, it's a lot of round tables, a lot of table topics to get people comfortable with each other and being more intimate. It's conducive to a of people. Essentially these guys are emerging family offices, right? They are they don't yet have that much money, but they also are not broke people, right? They're certainly all accredited investors. So these are the cohort to climb the ladder together. So we've done one every year. I think we're on our I think next one will be our eighth annual one. Um, Definitely have changed the program to be a little bit more conducive to. It's not a conference. It's more of like a summit or a camp. Sometimes I don't want to call it a camp, but it kind of that's the vibe I'm going for, right? Like that's how we do things in Hawaii. It's more family based, ohana based, a lot more a lot more informal. I think that's what kind of brings the barriers down and allows the opportunities for people to see, like, my family is on this trajectory, right? We're very into our finances, but we have these certain set of values. And I think that's what ties the group together. A lot of those values come from pretty much all of us are first generation multimillionaires, right? No trust fund babies here. Maybe we have a couple, but they're kind of rare.
Yeah.
Um, but it's just the DNA of you save your money, you work hard, you've made it to a good place, right? And maybe time to celebrate, but certainly you want to keep the momentum and find a cohort or a peer group around you that your family can also join and be a part of too.
How did you find the people to start your first cohort? Like, how did you market for
It
it?
was always just through like, in the beginning when I kind of started the brand in 2016, just build a list, right? Just send emails out to the list and it just started with that. And like I said, the first couple years just tested it out on some smaller informal events. I think we charge people like $50 to attend or something like that. But yeah, just at that time, I didn't really understand what we were trying to create. In my head,
Hmm.
I just had the vision of like, hey, it would be nice to have a group of people, certainly under 50 people, as opposed to these mega conferences of people that think the same way, same values, and then people can bring their families, and then also a place where like I always tell my wife, like, look, if I died, these are the people that here's a short list of these people who come that I trust that you go, you know you'll be so sad when I die, yet you'll have a big life insurance payout apparently. But these are the people that you consult with, right?
And so were they mostly just from your network that you already knew, or were you getting lists from
No,
like
yeah,
buying data?
from the power of the internet, right? Like people listen to my podcasts, and that in the very beginning stages, I just told my story, right? Like at that time, I was still buying little single family homes or in that mentality. So initially, like the brand used to be called Simple Passive Cash Flow. We kind of went away from that because deals don't cash flow, right? That's not what high net worth families do. They don't care about cash flow. That's what you do when you're kind of below the $5 million mark. You care about cash flow. after that point, it's more about equity growth, right? But back then, that was why the brand was called Simple Passive Cash Flow.
Gotcha.
But it was also about, we helped a lot of people buy little single family homes because that's what I did. Like, I don't really talk about things I haven't personally done myself. But that was kind of where I built a lot of traction. Since then, our group has definitely aged over the years. Like I would say, most people are in our 50s. So, I'm trying to catch up with them. But yeah, like I think initially, like we had a lot of guys in their 20s and 30s, those Henrys, right? High income, not wealthy yet, that, made $150,000, $250,000 a year from their tech jobs, had some energy because they didn't have kids yet and have that energy sucked out of them quite yet to buy single family homes and get a little more active. But I think the group has more grown up with me, right? As I've kind of abandoned that residential real estate single family home world, as I've kind of gone to the second floor and the third floor of the wealth elevator. And in my book, we have like this table of, that's always what I say first is figure out what floor you're at first, because that helps you understand self-awareness of where you're at first, as opposed to like, we live in a TikTok and YouTube short world where there's all these financial tips out there, but when the heck when is it prescribed at what point of the financial journey you're at?
Yeah, I think some of the most successful people I've known personally and studied, they have this incredible ability to identify what's signal and what's noise, because information is free now, especially with AI. Like anything you could possibly want to learn is free. You can figure it out at your fingertips, but it's the ability to determine and be able to decipher what is relevant to me and what is the correct information to actually act on and implement into my life for my goals, my mission, where I'm at now and where I want to go. And that's the hard piece, is knowing what information to actually listen to and what to follow, because everybody's got advice and not one thing works for everybody. Like there's multiple ways to skin a cat. I hate that saying, but it's so true. There's what works for one person doesn't mean it's going to work the best for you, or doesn't mean that wasn't the right strategy that's going to work for someone else.
Yeah, I mean, essentially, it's kind of like the process of learning, right? Or tackling down a big task. I mean, I'm in the middle of like a home move right now, so my house is in shambles. But what do? We try and pack up boxes and label it on the recording rooms. So no different than here. Like certain ideas, mindsets, even tax strategies are more pertain to when your net worth goes over $5 million, for example, right? Or some are when you're trying to get out of debt, right? Like the latte factor, that silly thing. But that's very important. That and keeping a freaking budget is very important for people under $500,000 net worth. But certain things only apply, at certain net worth ranges. And I think that's, to apply that framework at least helps makes it easier, right? Life's hard. We're gonna make it a little bit easier every time, right?
Yeah. So, okay, you've been doing this. When did you start raising capital? 2016?
Yeah, I think the first one, I think 2018, I think comes to
20.
mind. Yeah,
Okay.
might have been the year prior too, but yeah, definitely
in
after 2016.
so in 7 years, you guys have done 2 billion in transactions. So I'm still trying to figure out how you did that. So in such a short period of time. So like, who are you partnered with? What's your structure? How are you raising capital? Because to raise, like, how much capital do you guys have under management?
2 billion of past acquisitions. So I think where we really, to use the Mario Kart analogy, where we really hit that speed boost, I think around 2020 was when I mean, they always say like when you do your first deal or two, then you get fed a lot of deals, right? For us, that
Yeah.
was much prior to 2020. So I think around 2020, that was when we really, we hit that $1 billion mark around 2020 in there. If people recall, there was the whole pandemic thing, right? And there's a lot of
Right.
uncertainty. We pushed the pedal that year and took advantage of that, and
So
it could have worked out really bad. For us, it worked out pretty well that we picked up a lot of good assets in that 2020 time period. Locked up a lot of good interest rates too. But that was kind of where like that's where like in this business the brokers control a lot of deals.
Yeah.
Especially for us, like we don't go off market really, like or specifically like when we pick up assets, we don't we don't want to buy anything that's like 80% occupied or less, right? Like hair deals with hair on it,
Mm-hmm.
essentially. So therefore, the brokers will control those deals that are 85, 90% occupied or greater. So for us, just strictly speaking for us, the deal flow or the faucet is controlled by them. So when from the broker's perspective, you put yourself in their shoes, they're going to go to people who are hot and transacting, right? People who they see. So like, we put in a lot of offers, right? That's how we kind of get our name to the top,
Mm-hmm.
or that's how they know. I mean, you could be putting in, lowball offers, like I'm sure we were a bunch of times, but they would see our names, right? So that's one tactic that I think got us. And then obviously we closed the deal, right? So all the brokers know who closed the deal. So the lenders too, right? Like the lenders know who are the people who are actually doing stuff as opposed to just prancing around. So yeah, I think that was kind of where the culmination
Yeah.
of just a
Built a
lot
good
of deal flow.
reputation. Yeah, had the deal
Yeah.
flow. And where were you? Were you raising capital mostly from your retail investors, like the doctors, the lawyers, the smaller business owners, things like that? Or when did you shift to, because in the beginning you talked about shifting a little bit or working with institutional capital. When did you make that shift and what kind of percentage was retail investors versus institutional and which one do you like better?
Yeah, I mean, we work primarily with like retail investors, right? I think after like 2020 to 2024, we didn't really do much, right?
Yeah.
We were kind of in this transition period getting away from, well, since we couldn't do multifamily, right? Because nothing really worked. The price between buyers and sellers,
Mm-hmm.
there was a disconnect, and I still think that there's a big disconnect today. But what I started to realize is that there was a lot of distress in the market, and there's a lot of these good deals done behind the scenes off even the syndication street market done by larger players, institutional players. And what I started to, this is why I wrote the book, right? Like beyond the third floor of the wealth elevator is the penthouse. And then you get in your Willy Wonka glass elevator and then you go off and fly wherever. That's sort of where the family offices are. They can do whatever, right? They fly around in their glass elevators, go up, down, backwards, straight. So I would, we, this is coming from a kid from Hawaii who's never really had a rich uncle or knew any accredited investors. And now I'm interacting with people well beyond that, because we're buying properties from them, interacting with them, and then now kind of rubbing shoulder with those people. And what I realize is a lot of these people are like, third, fourth generation. And what they're doing is nothing that anybody can't do. What I realize, a lot of these guys, what they'll do is they'll hire somebody to go out and find deals and underwrite deals from them, and then you also put in together the construct of you have a fractional CFO or full-time accountant,
Mm-hmm.
right? Things
Right.
like that, but that's on the more operation side, but we're talking more deal flow, deal finding side. And then I was like, that's a good idea, why don't we do that, right? So I tried to, like just kind of like that's the key, is like I think understanding what the next level is and kind of just copy and emulating. So for me, it
Yeah.
was like, well, let me try and think like my family office. Like, well, we kind of are, right? We are a multifamily office these days, essentially what we are. So I was like, well, let's find what the multifamily offices do, right? And like I said, they have a guy that goes around, networks, business development, and looks for these deals that are good deals that they may want to invest alongside in. So, one good source is like some of the lending brokers that we've worked with in the past have kind of made us connections, right? Like they'll work with a family office that may take down a deal by themselves. And like, I mean, even like the distress in the market, in the capital markets, has made the opportunities kind of open up in
Mm-hmm.
this world, because before, family office, they just steamroll. They get the lending that they want, but now nothing's easy, right? It takes properties. I mean, you used to be able to close a deal in a couple months. Now, sometimes these damn closings take like 4 months to a year, right? We've
Mhm.
sold an asset, it took the buyer a year to get their financing in order.
Yeah. Yeah,
Um,
it can be a nightmare sometimes for sure. But
yeah, so that nightmare has created opportunities for us to, like, if there's a deal out there that needs a little push to get over the hump, I think that's where I saw the opportunity, at least for myself and us, right?
right. And so are most of your investors now like single family offices or multifamily offices? Or they're still
Um,
your retail
oh
investor?
yeah, retail,
Retail.
retail, yeah.
Okay, cool. So what's next for you?
I don't know. I mean, whatever what I've learned at least is like what got us here isn't going to get us to where we want to be. If I'm reading the tea leaves, interest rates aren't going to be coming down. The era of free money, the last decade, is not going to be coming around. So perhaps the old strategies didn't work, and we're just going to have to go to more audacious business plans. And investors may not want to hear that, but that's the only way I think you're going to be able to find alpha, But it also may be outside of the world of real estate. Like I'm a real estate guy. I still like real estate. I had unfortunately had 90% plus of my net worth in this last correction in commercial real estate and got killed. Some would say, well, that's how you got to concentrate to get to a certain level, then you diversify. And that's kind of what I've told myself too, right? But I'm trying to open things up a little bit. Again, I try and look to people who are more successful than me and I try and emulate them. And one thing I pick up on is that they are diversified outside of real estate,
Mhm.
right? Still alternative investments, still off market deals, but this is kind of where we open things up to more private equity, right? So, working with people that we know, like, and trust that can do the operation on a brick and mortar business or a virtual business, right? Buying websites, for example, things like that. Um, I think you have to have a lot more lobster traps out there
Yeah.
to find alpha. Unfortunately, a young non-accredited dude just can't buy a single family home in Birmingham for 80 grand and rent it out for $900 a month.
Yeah. Yeah, you always got to pivot. Everything's always changing all the time, and just like you said, what worked yesterday doesn't mean it's going to work today or tomorrow. And so, just being able to have the awareness of where things are going, and always have an edge. Like, to what problem am I a solution? And if you're just doing the same thing that everybody else and their brother is doing and you do not have an edge, then I don't really feel like that's a business that anybody should be in. That's going to really be that successful or last that long. And so even if you're doing a business plan that is similar to what other people are doing, what's the edge that you have specifically that's going to give you that advantage over the others?
Yeah, and I think like I mean, just thinking our clients in mind, like what is the problem that we solve for them? I mean, they're inundated in a sea of deals, like all these tech portals. I mean, their technology is great, but unfortunately, it just creates a shroud of just junk,
Mm-hmm.
and they don't know like what's what. Like I said, a lot of retail investors never get P&Ls and rent rolls, nor are they, underwriting specialists. So they need help, with more of a better viewpoint on it to make better decisions. I do think AI helps,
That's what I
but
was just going to
unless
say.
unless you have a baseline level of knowledge on this stuff, which again I think most passive investors don't have it. Respectfully, I say that. Like the AI will just tell you what you want to freaking hear, right? It's just a people pleaser, right?
Yeah.
I don't know why it does it. It's not like you're gonna fire ChatGPT or anything like that, but like, um, like that's the hard thing about AI. It just confirms your biases.
Yeah, I know that is one thing. And then as it learns you more and more, it can learn to continue to confirm your
Yeah, then it
biases.
doesn't want to get fired more. It's like,
Yeah. Yeah.
oh,
That's funny. Well, awesome. Well, it's been really good. I know I did want to dive into a bunch of more things, and you just said that you had some pretty big losses in this correction. Was that in your own funds? I know we have to wrap up here, but I just out of curiosity, was that were you an LP or was that in your own operating company where
oh,
you just had
that's
deals go bad?
everything. Yeah, I
Yeah.
mean, I'm alongside of that personally too. Yeah,
Ugh,
yeah,
that's rough.
yeah. But yeah, like that's you talk to any operators that've been around through like a correction or two,
Oh yeah.
Now we've seen a bigger one now than 2008 in commercial real estate. In fact,
Yeah.
or the guys going in 2008, it's kind of par for the course, right? And that's why when I get on the phone with every single investor and we have this talk, it's like, look, man, I can't promise anything is going to happen. Everything's projected, but like, I mean, that's why you try and underwrite the best deals at the time. We don't know if these are going to go well, but again, the philosophy is if you just dollar cost average over 4 to 7 years in the best deals at the time, yeah, when the market comes correcting down, and hopefully next time it doesn't come correcting down 30% like it did, right? Like
Right.
cap rates went up 1.5%, right? Normally you stress test deals for maybe a half of that, right? But at the same time, if you never pull the trigger, then what do they say? If you don't risk it, no biscuit too. So the nice thing about investing in this method as an LP is your downside is protected, right? Like if the asset falls and is now 20 million under the senior debt because the market fell so heavily, well, you're the LP, you're not the loan guarantor, you know, you lose your principal and that's horrible, right? But it's not like anybody's chasing after you in the delta, or just like a lawsuit, right? Like a frivolous lawsuit, like a tenant falls or there's a pool drowning or something, a lot of pools. At least they're not coming after you personally, right? So if you
Right.
kind of play this game where you're just dollar cost averaging and you take advantage of the wins when they do come, and they typically come in the beginning of the market cycle, which technically I feel like we're at right now. I've already seen some assets come up significantly off the bottom of the market back in late 2023 into 2024. And I have some appraisals kind of to prove that within our own portfolios. Of course, those are just individual data points, right?
Yeah.
Not indicative of the market, but these are the signs that will only be verified 2 or 3 years from now, but then it'll be way too late, right? It's like kind of picking up on, wow, 2010 to 2012 was a great time to invest. Too bad it's freaking 2016.
Right. Yeah. Yeah. Just trying to catch as close to the bottom as you can and not getting wiped out at the top. That's the problem, is you get wiped out at the top and then you don't have the cash to be able to re-enter when it's actually the time to re-enter.
Yeah, and that's my philosophy, is you never know when the market tops and bottoms are going to be. Like if people know, awesome, let me invest with you guys. Give me your email address, please. But I have the thought that I just don't know. So I'm just gonna head out there and try my best every day, hit every golf shot with as much effort as possible, which means every deal that you do, right, like underwrite it, stress test it to a certain amount, and just pick the best deal that you're presented or you see, that quarter, for example, right?
Yeah. Well, thank you so much for coming on. It's been great to chat with you and get to know you. And how can people get a hold of you if they want to get involved?
They can shoot me email, lane@thewealthelevator.com.
Awesome. And I'm excited to read your new book.
Thanks.
All right. I'll see you later. Thanks for coming on.
Thanks, Hannah. Bye.
Bye.